Even at historically low interest rates, it's still hard to get deals done. Market uncertainty has shaken the world of mergers and acquisitions, which thrives on bullish sentiment. Well, for more, we turn to Marshall Sonenshine, chairman of investment bank Sonenshine Partners, and Marshall has advised on billions of dollars of M&A deals. Marshall, you've been on Fast Forward before. Great to have you back.
Nice to be back.
It looked like 2011 would turn out to be a better year, perhaps, than 2010. But the last two quarters, really, certainly this coming quarter and last quarter, are not starting off well.
Well, what was it? Yogi Berra said it's the future that's the hardest to predict. So we had a good first half of the year, and we've had a pretty rocky summer. We were in a strong recovery mode in terms of financial markets in the first half of this year, particularly M&A. We've seen about $1.5 trillion of deal flow on a first half basis, which positioned us for $3 trillion, which is not so bad compared to where we were pre-financial crisis a few years ago. But we've got summer doldrums big time now. Doldrums is an understatement. We've got real problems that are the continuance and the ripple effects of the financial crisis that's still with us.
How much of it, though, is specific to all the market volatility we've seen? Certainly, stocks are much lower than where we started the summer off. And how much of this perhaps has to do with what's happening in Washington? We've been talking quite a bit about AT&T and T-Mobile and sort of an antitrust environment. Which of those factors is playing the biggest part in the M&A flow?
Well, let's tease apart a few different issues. I think antitrust is certainly an important issue right now for M&A, but it is almost an afterthought at the moment to what is a much more significant and serious problem for financial markets, which is grave instability, persistent unemployment, and very, very anemic growth, if any, in many of the world's most developed markets. That's the backdrop. We thought we were coming out of that, or at least markets thought we were. Some of us actually were a little skeptical about that, but it looked a little bit better at several moments in time earlier this year than it looks right now in terms of an outlook. In terms of antitrust, we saw in the bull market relatively little antitrust enforcement at all. Antitrust had been a very, very important staple of merger and acquisition practitioner life. It's something you always look at, something you're always concerned about traditionally. But in the years leading up to the financial crisis, there was relatively little antitrust enforcement of any kind. I don't mean that in any nefarious sense. The outer limits of antitrust were not really being tested all the time either. Today, we're now seeing defensive consolidation of industries. So, for example, the International Paper deal proposing to buy out Temple Inland after a fair amount of hostile and difficult negotiation with that board would give a very significant increase in that company, International Paper's market share in corrugated packaging materials. That's a serious issue.
You think they're going to have problems getting the deal done?
I haven't looked at the deal from an antitrust analytic perspective. I don't want to say more than I really can as a market observer. But I think anytime you see a company whose market share might go into the 30s in terms of percentage, you're in territory where you're certainly going to get reviewed, and there's certainly a question. Now, in that case, there may be solutions in terms of divesting some of the assets to bring that market share down a little bit. When you get into much more complex markets like wireless, where you see AT&T proposed earlier this year to spend $39 billion to buy T-Mobile, and guess what? The Justice Department has a different opinion on that. And now Sprint is piling on and weighing in, as the antitrust laws give them the right to do. There's both public enforcement and private enforcement of antitrust laws in this country, as is true also of many areas of securities laws. And they're going to have their day in court, literally. And I think there's a real question when you're bringing an industry from 4 major participants to 3. There is a consumer at the end of every food chain in every industry, and there is one watchdog at the end of the road in every deal, and that's called the Justice Department. And if it doesn't look right, it's going to get reviewed, and then you're going to get an answer. And we are now in, oddly, a moment in time when it's great to see deals happening. It makes everybody feel better. There is that conviction that deals express. But on the other hand, there is a consumer at the end of a marketplace, and the government's job is to look after that.
And there is more focus on the consumer, certainly. But in that context, if you are advising a company right now that is potentially looking to acquire, has a lot of cash, what do you think about the breakup fee? Because that's a big part of this conversation with AT&T and T-Mobile.
Well, that was a huge fee. That was a $3 billion breakup fee that AT&T signed up for, and they basically said, we'll take the risk. Now, in a $39 billion deal, that's a big breakup fee. You don't normally see breakup fees that big. Now, it's hard for me, as I'm not an insider on that deal, and if I were, I wouldn't be able to talk to you about it. It's hard for me to Monday morning quarterback any element of a deal, but I will say a $3 billion breakup fee is one whopper fee, and to subject yourself to risk of losing that money over an antitrust review of that deal is real risk. Now, whether that was an intelligent risk for AT&T to take, given what they're trying to get out of that deal and the price at which they got it, I can't say. I just would observe that that's one hell of a big breakup fee.
As an industry expert, what other deals, though, are you watching closely that could perhaps set a precedent or change the tone in terms of M&A activity?
Well, Lisa, we're seeing so much fragmentation right now in the deal business. There is a huge amount of momentum. Deal practitioners, our firm, lots of other firms, really do have a lot of activity right now. We've actually closed a whole bunch of terrific deals. Just earlier this summer, we completed an almost $500 million merger of Drugstore.com into Walgreens. That was also a very strategic deal. A lot of the deals that are happening right now are strategic. I think that that removes one risk factor because those are not deals that are typically stuck on financing. Usually, if you have a good, strong acquirer like a Walgreens in that case, they're going to close come hell or high water. If they like the deal, they're going to get that done, and presumably
they don't need to organize financing.
No, but the buyout community, the leveraged finance community, is really on thin ice right now. We've seen a groundswell of activity in all three categories: leverage loan, high yield, and equity and follow-on offerings. But right now, that was before the
this
summer
is really
doldrums.
Since
right
August.
Now, this is yes, and a lot of the deals that went into the backlog in August that large banks are underwriting, there's going to be a real question mark. Some of them are going to stay on their balance sheets if they do those deals, and some of those deals are going to get deferred as far out as they can defer them, depending on what commitments have been made, and some of them are not going to get done because right now there's simply less and less conviction about the ability to foresee business performance, and therefore lenders are going to hold on to their pocketbooks a little bit longer. We may be in low interest rate environments, but it's for the reason that we're in low confidence environment, and that's the problem.
All right, we are heading into campaign season very quickly. Is there a specific thing you're looking to hear from the president and any other candidates, with their hat in the ring?
Well, I think that right now it's about jobs first and foremost. Stimulus has become almost a bad word for about half of Congress, being the Republican side. The reality is we haven't had a serious round of stimulus that is job creation oriented in nature. We need infrastructure. If we have that, we may be able to rally some support around it, but it isn't going to be easy. But I think the president's task on Thursday is to give confidence that we're going to spend money in Washington not to dig a hole and fill it. That isn't going to help us. We're going to spend money to put people to work in things that are inherently productive. I personally think this is a moment for Keynesianism. I personally think that improving our infrastructure, maybe something akin to what we had in the 30s in the Work Projects Administration, would be a sensible thing. I hope that will be in the mix. I'm a little bit skittish about whether it will because I think he's going to bow to political reality and be more tepid in what he's going to serve up, but we'll see.
All right. It certainly has been the precedent. All right, Marshall, we got to leave it there. Thank you
Good.
so much for joining us.